Before we dive in, it is crucial to understand that I am not a financial advisor, and this presentation does not constitute financial advice. This video is intended for educational and informational purposes only. A reverse mortgage is a complex financial product with significant implications. You should always consult with a qualified, independent financial advisor, a housing counselor approved by the U.S. Department of Housing and Urban Development, and your family before making any decisions. Imagine for a moment, you've spent 40, maybe 50 years of your life working. You've played by the rules. You poured your heart, your sweat, and your savings into a home. It's more than just wood and drywall. It's where you raised your family, where you celebrated holidays, where every corner holds a memory. You paid off the mortgage and now it's yours, free and clear. It's your single biggest asset, your nest egg, the monument to your life's work. But now in retirement, a quiet anxiety starts to creep in. Social Security helps, but it doesn't cover everything. The cost of groceries, gas, prescriptions, it all keeps climbing. The property tax bill seems to get bigger every year. The roof is starting to look a little worn, and you know that's a 5-figure repair bill waiting to happen. You're living in a $500,000 asset, but you're counting pennies at the grocery store. This is the paradox that millions of American seniors are facing right now. You are house rich but cash poor. What if there was a way to unlock a portion of that money trapped in your walls? A way to turn your home equity into a tax-free stream of cash without having to sell the home you love? And this is the part that sounds too good to be true, without ever having to make a single monthly mortgage payment for as long as you live there? That is the promise of a reverse mortgage. And it's also the source of its controversy. For decades, this financial tool has been one of the most misunderstood and hotly debated products in the United States. You've probably seen the late-night TV commercials with the smiling, silver-haired celebrity spokespeople, promising a golden, worry-free retirement. But you've also probably heard the horror stories, the whispers from a neighbor or a nephew about someone who lost their home, who was taken advantage of, who fell into a trap. It's been called a financial lifesaver by some, and a predatory scam by others. So what's the truth? That's why we're here today. We are going to cut through all of the noise, all of the marketing fluff, and all of the fear-mongering. By the time this presentation is over, you will have a crystal clear understanding of what a reverse mortgage is, exactly how it works, the different ways you can receive your money, and who is eligible. We will break down the real costs and fees, the ones they don't always talk about in the commercials. We'll expose the most dangerous myths and confirm the surprising truths. Most importantly, you will learn about the powerful safeguards and consumer protections that have been put in place to protect seniors. This video will give you the unbiased, straightforward knowledge you need to determine if this is a viable option for your financial situation, or a potential pitfall you need to steer clear of. The need for this clarity has never been more urgent. We're living longer than ever before, which is a wonderful thing, but it also means our retirement savings have to stretch further than ever before. The dream for over 90% of seniors is to age in place, to live out their years in the comfort and familiarity of their own home. A reverse mortgage, when used correctly and for the right reasons, can be the tool that makes that dream a reality. It can be the difference between struggling to pay for in-home care and getting the help you need. It can be the fund that finally lets you replace that 20-year-old furnace, or the safety net that protects your other investments during a stock market downturn. But if it's used incorrectly, or by someone who doesn't fully understand it, it can lead to heartache for you and your family. So let's start at the very beginning with the most fundamental question. What exactly is a reverse mortgage? Let's forget the fancy name for a second and just think about the concept. A traditional mortgage, the one you're familiar with, is a loan you take out to buy a house. Every month you send a check to the bank. With each payment, your loan balance goes down and your home equity, the part of the home you truly own, goes up. It's a forward-moving process. A reverse mortgage does the exact opposite. Instead of you paying the bank pays you. You are taking the equity you've already built up in your home and converting it back into cash without selling your home. The most common type in the United States, and the one we will be focusing on, is called a home equity conversion mortgage, or HECM. This is critical because HECMs are insured by the Federal Housing Administration, the FHA, which is part of the U.S. government. This federal insurance provides a layer of protection that we will discuss in great detail later. So, how does the bank pay you? You actually have several options. You could take the money as one big lump sum payment. This might be useful if you have a large, immediate expense, like paying off an old mortgage or making a major home modification for accessibility. Another option is to receive a steady stream of monthly payments, either for a set number of years or for as long as you live in the home. This can act like a monthly paycheck, supplementing your Social Security or pension income to help with regular bills. Perhaps the most flexible and popular option is a line of credit. This works like a credit card, but with your home's equity as the limit. You can draw from it as you need it, a little this month for a dental bill, a larger amount next year for a new car. You only pay interest on the money you actually use, and the unused portion of the credit line actually grows over time, giving you more borrowing power in the future. You can even use a combination of these methods. Now, this all sounds pretty good, but it naturally leads to the single biggest question and the most pervasive fear surrounding reverse mortgages. If the bank is paying me and I'm not making any payments back, does the bank now own my home? The answer is an unequivocal, absolute no. Let me say that again. You do not sign over the deed to your house. Your name and your spouse's name, if they are on the loan, remains on the title. You are still the owner of your home just as you were before. You have all the rights and responsibilities of a homeowner. You're responsible for paying your property taxes, your homeowner's insurance, and for maintaining the property, keeping it in good repair. The bank simply has a lien on the property, the same way they did when you had a traditional mortgage. They have a claim to be repaid in the future, but they do not own your home. This is the foundational truth you must understand before we go any further. You retain ownership. So, if you keep ownership and you're not making monthly payments, the next logical question is a big one. When and how does this loan ever get paid back? That is the million-dollar question, isn't it? Or, more accurately, the several $100,000 question. And the answer is simpler and frankly more humane than most people think. The loan is paid back when the homeowner no longer lives in the house as their primary residence. That's the trigger. This event, whatever it may be, is officially called a maturity event. It's not a date on a calendar. It's a specific change in your life circumstances. There are 3 primary maturity events that cause the loan to become due and payable. Let's walk through them one by one. The first one is the most straightforward. You sell the house. Maybe you and your spouse decide you want to move to a different state to be closer to your grandkids. Or you want to downsize to a condo on the beach. You are always in control. You can decide to sell your home at any time for any reason, just like you could with a traditional mortgage, or if you own the home outright. When you sell the house, the process is familiar. At the closing, the reverse mortgage loan balance is paid off from the proceeds of the sale, just like any other mortgage. And the rest of the money, that's yours. Every single penny of the remaining equity belongs to you. If your home is worth $500,000 and your loan balance is $200,000, you walk away with $300,000 tax-free. The bank doesn't get a cut. They get back what they lent you, plus the accrued interest and fees. That's it. You remain in the driver's seat. The second maturity event is when you move out of the home permanently. The key word here is permanently. A reverse mortgage is designed for your primary residence. It's the home you live in. So, if you go on a 6-month cruise around the world, that's fine. If you spend the winter in Florida every year, that's fine. The loan is not affected. But if you move into an assisted living facility or a nursing home and you're gone for more than 12 consecutive months, the home is no longer your primary residence. At that point, the loan becomes due. Again, this doesn't mean the bank swoops in and seizes the property. It means you or your family acting on your behalf have a decision to make. You can sell the home, pay back the loan, and use the remaining equity to help pay for your long-term care. Or, if a family member wants to keep the house, they could arrange to pay off the reverse mortgage balance through other means like getting a new mortgage in their own name. The options are still there. Now for the third maturity event. This is the one that causes the most confusion and the most fear. It's what happens when the last surviving borrower passes away. This is the scenario that fuels the myth that the bank takes your house. Let's be crystal clear. The bank does not want your house. They are a financial institution, not a real estate management company. When the last owner passes away, their ownership of the home transfers to their heirs, to their estate, just like any other asset they owned. The house belongs to your kids or whoever you've named in your will. But the house still has a loan against it, the reverse mortgage. So your heirs are given a choice. They typically have up to 6 months, and can sometimes request extensions for up to a year, to decide how they want to settle the loan. They have 3 basic options. First, they can choose to sell the house. They'll work with a real estate agent, put it on the market, and sell it for full market value. From the proceeds, they'll pay off the reverse mortgage loan balance. Whatever is left over, all the remaining equity goes directly to them, to the estate. If the home sells for $600,000 and the loan balance is $250,000, the heirs inherit $350,000. This is by far the most common scenario. Second, if your heirs want to keep the house in the family, they absolutely can. Perhaps it's the home they grew up in, and it has immense sentimental value. To do this, they simply need to pay off the reverse mortgage loan balance. They can do this with their own money, or, more commonly, by getting a new traditional mortgage on the property in their own name. They essentially refinance the home to pay off the reverse mortgage. The house is then theirs, free and clear of the reverse mortgage lien. The third option is simply walking away. If the heirs don't want to deal with selling the home and there isn't much equity left, they can choose to sign the deed over to the lender. The lender will then sell the property to recoup the loan balance. And even in this case, if the lender sells it for more than what was owed, that extra money still goes back to the estate. The bank is only ever entitled to what they are owed. But this brings us to the single most important feature of a government-insured reverse mortgage. It's the ultimate safety net, the one thing that should put the biggest fears to rest. It's called the non-recourse feature. This is a powerful protection. Non-recourse means that you or your heirs will never, ever owe more than the value of the home when the loan is repaid. Let's imagine a worst-case scenario. Let's say you took out a reverse mortgage in 2006, right at the peak of the housing market. Your home was appraised at $700,000. Over the next 15 years, you draw funds and the interest accrues. Then, a massive housing market crash happens, worse than 2008. When you pass away, your loan balance has grown to $450,000. But your house, due to the crash, is now only worth $400,000. Your heirs look at the situation. They owe $450,000, but the house is only worth $400,000. They are $50,000 underwater. In a normal loan situation, this would be a disaster. A lender could potentially go after the estate's other assets, savings accounts, stocks, other property, to cover that $50,000 shortfall. Your kids could be on the hook. But with a government-insured reverse mortgage, that is legally impossible. Because it's a non-recourse loan, the house is the only asset that can be used to repay the debt. The lender cannot touch any other part of your estate. They can't go after your savings, your investments, or your children's bank accounts. That $50,000 gap? It's not your family's problem. It's covered by the FHA mortgage insurance that you paid for as part of the loan. That insurance is precisely for this kind of worst-case scenario. It protects the lender from a loss, which in turn protects your family from ever owing more than the home is worth. Your heirs can simply let the lender sell the home for its $400,000 market value, and the loan is considered paid in full. The remaining $50,000 of debt vanishes. It's forgiven. This is a fundamental ironclad guarantee. You can access your home's equity without ever putting your other assets or your children's inheritance at risk. So let's recap the repayment. It's not a ticking clock. It's an orderly process triggered by a major life event. You sell the home, you move out permanently, or you pass away. In every scenario, you or your heirs are in control. You get to decide how to handle it. And most importantly, thanks to the non-recourse protection, your family will never be burdened with a debt that's larger than the value of the home itself. The debt is tied to the house and only the house. Understanding this repayment process, especially the non-recourse safety net, is critical. It transforms the reverse mortgage from something scary and unknown into a structured and protected financial tool. Now that we've tackled the two biggest myths, the myth of ownership and the myth of repayment, we can start to see what this tool is actually designed for. We understand that you keep the title, and we understand how the loan is eventually settled in a safe, predictable way. The next piece of the puzzle is figuring out who can even get one of these loans. It's not for everyone. There are specific, and sometimes surprising, rules about your age, your property, and your financial situation that determine if you even qualify. And that's exactly what we're going to break down next. What are the 3 essential pillars of eligibility you absolutely must meet? The first pillar, and the most straightforward, is AGE. For the most common type of reverse mortgage in the United States, the one insured by the federal government called a home equity conversion mortgage, or HECM, you must be at least 62 years old. Not 61 and a half. Not turning 62 in a few months. On the day you close the loan, you must have passed your 62nd birthday. Now, why 62? It's not an arbitrary number. The entire financial architecture of a reverse mortgage is built on actuarial tables and life expectancy. The lender is making a long-term bet. And the age of 62 is the point where the math starts to work for a loan designed to last for the remainder of a homeowner's life. It solidifies its purpose as a tool for retirement, not a mid-career cash grab. But this is where we hit our first critical nuance, a rule that has changed over the years and provides a powerful protection. What if you're a couple and one of you is 65 but the other is only 59? Does the younger spouse disqualify you both? The answer, thankfully, is no. The 65-year-old can still be the sole borrower. The 59-year-old would be designated as an eligible non-borrowing spouse. This is a hugely important concept. Years ago, this wasn't the case and it led to tragedy. A borrowing spouse would pass away, and the younger, non-borrowing spouse, whose name wasn't on the loan, would suddenly find the loan due and payable, often forcing them to sell their home. The rules have since been fixed. Today, an eligible non-borrowing spouse has protections. If the borrowing spouse passes away or has to move into a care facility for more than 12 months, the younger spouse can remain in the home for the rest of their life, provided they continue to meet the obligations of the loan. We'll talk about those in a minute. They won't receive any more money from the reverse mortgage, but they also won't be kicked out. They get to stay in their home. The one catch is that having a younger, non-borrowing spouse will typically reduce the amount of money you can access, because the loan is now calculated based on a longer potential lifespan in the home. It's a trade-off. Less money but more security for your partner. So that's pillar 1. You're 62 or older or you have a spouse who is. Check. The second pillar is your property. This isn't just about owning a home. It's about owning the right kind of home, and in the right way. First and foremost, the property must be your principal residence. This is non-negotiable. A reverse mortgage is designed to help seniors age in place. It is not a financial tool to pull cash out of your vacation home, your ski condo, or that duplex you rent out 2 states away. You have to live there the majority of the year. This is a core tenet of the program. Next is the type of property. Most people think it's just for single-family homes, but the list is broader than you might expect. Single-family homes are, of course, the most common, but you can also get a reverse mortgage on a 2 to 4 unit property, as long as you occupy one of the units as your principal residence. Think about that. You could live in one unit of a fourplex, use the reverse mortgage to eliminate your mortgage payment, and continue collecting rent from the other 3 units. That's a powerful cash flow scenario. Condominiums can also qualify, but this is a major stumbling block for many. It can't just be any condo. It must be in a project that is approved by the Federal Housing Administration, or FHA. The FHA has strict criteria for condo associations regarding their financial reserves, insurance, and the percentage of renters versus owners. If your condo association isn't on the FHA's approved list, you cannot get a HECM reverse mortgage. You can check the FHA's official website to see if your building qualifies. Finally, certain manufactured homes can also qualify, but again with strict rules. The home must be built after June 1976, be on a permanent foundation, meet specific size requirements, and you must own the land it sits on. Beyond the type of property, there's its condition. The home must meet FHA minimum property standards. The lender will require an appraisal, and that appraiser isn't just determining the value. They're also a building inspector. They're looking for any issues that could threaten the health and safety of the occupant or the structural integrity of the home. Things like a leaky roof, peeling lead-based paint, a broken furnace, or major foundation cracks will have to be repaired before the loan can close. Sometimes you can even use funds from the reverse mortgage itself to pay for these repairs, but they must be completed to move forward. The lender needs to protect their collateral, which is, after all, your home. So that's pillar 2, property. It's your primary residence, it's an approved property type, and it's in reasonable condition. Check. Now we arrive at the third and most complex pillar, your financial situation. This is where the rubber truly meets the road. It breaks down into 2 main parts. First, you must have significant home equity. There's no magic number, but generally you need to own your home free and clear, or have a very small remaining mortgage balance. Why? Because the reverse mortgage must be the one and only loan against your property. It has to be in first lien position. If you still have an existing mortgage, the very first thing you must do with the reverse mortgage funds is pay it off completely. Let's say your home is worth $500,000, you still owe $100,000 on your original mortgage, and you qualify for a $250,000 reverse mortgage. The day you close, that first $100,000 is automatically sent to your old lender to wipe out that debt. The remaining $150,000 is then available to you. If you owe $260,000 on that home, you wouldn't qualify because the loan isn't large enough to pay off the existing debt. The goal is to eliminate your monthly principal and interest payment, not just add another loan on top of it. The second part of the financial pillar is the most misunderstood. It's called the financial assessment. This is a relatively new requirement, put in place after the 2008 housing crisis to prevent the heartbreaking foreclosures that plagued the early days of reverse mortgages. Back then, lenders gave out money without checking if the homeowner could actually afford the ongoing costs of homeownership. People would get a lump sum, spend it, and then a few years later find they couldn't afford the property taxes. They'd default, and the lender would be forced to foreclose. To stop this, the government now requires every lender to conduct a thorough financial assessment. They will look at your income, your assets, and your credit history. But here's the key. They are not trying to determine if you can pay back the reverse mortgage loan balance. We already know you don't have to do that. They are trying to verify one thing and one thing only: your ability to handle the mandatory obligations of the loan. You must prove you have the willingness and financial capacity to pay your property taxes, your homeowner's insurance, and any HOA fees on time, every time, for the rest of your life. You also have to maintain the home. If your credit history is shaky or your monthly income is very tight, the lender might get nervous. But it doesn't necessarily mean you'll be denied. Instead, it may trigger a requirement for something called ELISA, which stands for Life Expectancy Set Aside. ELISA is a portion of your own reverse mortgage proceeds that the lender puts into a special escrow account. They then use that account to automatically pay your future property taxes and insurance bills on your behalf. Think of it as a safety net. It reduces the amount of cash you can access for other things, which can be a downside. But the upside is immense peace of mind. You know for a fact that the two biggest bills that could cause you to lose your home are taken care of, guaranteed for the life of the loan. Finally, there's one last gate you must pass through before you can even submit an application. You are required by law to complete a counseling session with an independent, third-party counselor approved by the Department of Housing and Urban Development, or HUD. This person does not work for the lender. They have no skin in the game. Their sole job is to be your advocate. They will walk you through the entire process, explain the costs, review your personal situation, and discuss alternatives to a reverse mortgage. They make sure you understand exactly what you are signing up for. Once you complete this session, you get a certificate, and only then can you formally apply. So there you have it. The pillars of eligibility. You must meet the age requirement. Your property must qualify, and you must pass the financial assessment, demonstrating you have enough equity and the capacity to keep up with taxes and insurance. Now that you know if you can get in the door, the next question is the big one. How much money can you actually get? The answer isn't a simple percentage. It's a complex calculation based on the age of the youngest borrower, the current interest rates, and the appraised value of your home. And we're about to unravel that exact formula, showing you how lenders determine the final number that could change your retirement. It's a calculation that feels like it's locked away in a vault, but today we're cracking it wide open. This isn't just about numbers on a page. It's about understanding the engine that powers the entire reverse mortgage machine. Think of it as three giant pillars holding up the final loan amount you can receive. Get these three pillars, and you'll understand more than 95% of people who even consider a reverse mortgage. The first, and by far the most influential pillar, is age. Specifically, the age of the youngest borrower. In the world of reverse mortgages, age isn't just a number. It's your primary asset. The older you are, the more money you can access. Why? It's a matter of actuarial science. Lenders use life expectancy tables to estimate how long the loan will likely be outstanding. The older you are, the shorter that time horizon is, which means the loan has less time for interest to accrue. This reduces the lender's long-term risk, so they can offer you a larger percentage of your home's value up front. Let's make this real. Imagine a homeowner named Bill. At age 62, the minimum age to qualify, Bill might be able to access, say, 40% of his home's value. But if Bill waits 10 years and applies at age 72, that percentage could jump to around 50%. If he waits until he's 82, it could be closer to 60% or more. It's a significant increase. The system is designed to reward longevity. It's a fundamental feature, not a bug. This is also why if you're applying with a spouse, the calculation is always based on the younger person. If a 75-year-old man is married to a 65-year-old woman, the entire calculation is based on the 65-year-old's age. which would result in a lower loan amount than if the man applied alone. This is to protect the younger spouse, ensuring they can remain in the home for their entire life under the terms of the reverse mortgage. But it's a critical factor to understand when you see the final numbers. So pillar number 1, age is king. The older the youngest borrower, the bigger the potential payout. The second pillar is the financial weather vane of the entire operation: interest rates. Now this gets a little tricky because it's not the interest rate you see advertised on the news for a traditional 30-year mortgage. For a HECM reverse mortgage, lenders use something called the expected interest rate. Think of it as a financial forecast. It's a blend of a long-term interest rate index plus the lender's margin. It's the rate the lender anticipates the loan will average over its entire lifespan. Here's the golden rule you need to remember. The relationship between the expected interest rate and your payout is inverse. When interest rates go down, the amount of money you can borrow goes up. When interest rates go up, the amount of money you can borrow goes down. It's a seesaw. Why? Comes back to that same risk calculation. A higher expected interest rate means the loan balance will grow faster over time. To ensure the final loan balance doesn't exceed the home's value by too much, the FHA requires lenders to start you off with a smaller initial loan amount. A lower rate means slower loan balance growth, giving them the confidence to offer you more money from the start. The impact of this is staggering. A single percentage point change in the expected rate can alter your available funds by tens of thousands of dollars. Someone who got a reverse mortgage in a low-rate environment might have accessed significantly more cash than their neighbor with the exact same home value and age, who applied just a year later in a higher-rate environment. This pillar is the one you have the least control over, as it's tied to the broader economy, but its timing can dramatically shape your retirement. It's not about timing the market, but understanding that the market will time you. Now for the third pillar, and this is where a lot of misconceptions live: your home's value. People naturally assume, my home is worth $500,000, so I can borrow against that full amount. But that's not quite how it works. The calculation is based on the lesser of two numbers, either the appraised value of your home or the national FHA lending limit, whichever is lower. This maximum value used in the calculation is called the maximum claim amount, or MCA. As of 2024, the FHA national lending limit is $1,149,825. Let's say your home in California is appraised at $2 million. For the reverse mortgage calculation, it doesn't matter. Your home's value is capped at that FHA limit. The lender will use the $1.15 million figure, not the $2 million figure, to determine your loan amount. Conversely, if your home is appraised at $400,000, which is less than the FHA limit, then the lender will use your $400,000 appraised value. This FHA limit is a crucial safety rail. It prevents the FHA insurance fund from being overexposed on extremely high-value properties and keeps the program sustainable for everyone. So, pillar number 3 is your appraised value, but only up to the federal ceiling. So we have our 3 pillars: age, interest rate, and the maximum claim amount. But how do they combine? They are fused together by something called the principal limit factor, or PLF. This is the magic number. The PLF is a percentage that is published by the Department of Housing and Urban Development, or HUD. It's literally a giant grid, a table. On one axis, you have the borrower's age. On the other axis, you have the expected interest rate. The lender finds where your age and the current rate intersect on that table, and that gives them the principal limit factor. This PLF percentage is the key to everything. It is the exact percentage of your home's value, up to the FHA limit, that you are eligible to borrow. Let's walk through a clear, simple example. Let's meet Sarah. She is 75 years old and applying on her own. Her home is appraised for a clean $500,000. Since this is well below the FHA limit, her maximum claim amount is $500,000. Let's say the current expected interest rate is 5%. The lender goes to the official HUD PLF table. They find the row for age 75 and the column for a 5% expected rate. Let's say the number at that intersection is 0.551. That means Sarah's principal limit factor is 55.1%. Now, the final calculation is beautifully simple. Maximum claim amount multiplied by the principal limit factor. For Sarah, it's $500,000 times 0.551. That equals $275,500. This number, $275,500, is her initial principal limit. It represents the total gross amount of money available to her through the reverse mortgage. It's the total pool of funds she can draw from, including all costs, fees, and any existing mortgage payoffs. This is the big number. It's the result of that secret formula. But here is the critical twist, the one thing you absolutely must understand before moving on. This $275,500 is not the check that arrives in her mailbox. This is the starting line, not the finish line. This is the gross amount, the total lending power she has unlocked. Before Sarah can decide how to receive her money, whether as a lump sum, a monthly payment, or a line of credit, that initial principal limit has to first cover all the upfront costs of the loan. And most importantly, it must first be used to pay off any existing mortgage she might have on the house. What's left over after all of that is the net proceeds available to her. And understanding those costs and how they peel away at that initial number is the next crucial piece of this puzzle. So let's break down those costs one by one. Think of it like an itemized receipt. When you get a reverse mortgage, specifically the FHA-insured home equity conversion mortgage, or HECM, you're not just getting a check for the full amount you're approved for. There are upfront costs, and they are typically financed into the loan itself. This means you're not writing a big check from your savings account on closing day. Instead, these costs are paid from the loan proceeds before you receive your money. First up is the origination fee. This is the lender's fee for processing, underwriting, and closing your loan. It covers their work, their overhead, their expertise in putting the entire package together. The FHA sets very specific limits on how much a lender can charge for this. It's calculated as 2% of the first $200,000 of your home's value, and then 1% of the amount above that. But, and this is a big but, the total origination fee is capped at $6,000. So no matter if your house is worth $800,000 or $2 million, the most a lender can charge for this fee is $6,000. Let's go back to our example, Mary, with her $400,000 home. 2% of the first $200,000 is $4,000. Then, 1% of the remaining $200,000 is another $2,000. Add them together and you get $6,000. So for Mary, the origination fee hits that FHA cap exactly. This $6,000 fee is the first thing that will be deducted from her total loan amount. Next, we have what is arguably the most important, and often most misunderstood, cost, the mortgage insurance premium, or MIP. Because the HECM is an FHA-insured loan, this insurance is mandatory. It's not for you like homeowners insurance. It's for the loan itself, and it protects both you, the borrower, and the lender. This MIP is broken into two parts. The first part is the initial mortgage insurance premium, or IMIP. This is a one-time fee paid at closing, again financed into the loan. Currently, this fee is a flat 2% of your home's appraised value. For Mary's $400,000 home, 2% is $8,000. Now that might sound like a lot. You might be thinking, $8,000 for insurance? What am I getting for that? Well, you're getting the single most powerful feature of a reverse mortgage, the non-recourse guarantee. This insurance is the FHA's promise that you, or your heirs, will never, ever owe more than the value of the home when the loan comes due and the house is sold. If the housing market crashes, and your loan balance balloons to be more than what your home is worth, the FHA Insurance Fund covers the difference. The lender gets paid back, and your family isn't stuck with a massive bill. This insurance also guarantees that if your lender were to ever go out of business, the FHA would step in and ensure you continue to receive your loan payments as promised. It's a powerful safety net that makes the whole program work. That $8,000 is buying you and your family ultimate peace of mind. The second part of the mortgage insurance is the annual mortgage insurance premium. Despite its name, you don't pay this annually out of your pocket. Instead, this is a smaller, ongoing charge that is added to your loan balance over time. It's calculated at a rate of 0.5%, that's 0.5%, of the outstanding loan balance each year. So as your loan balance grows, the amount of this annual MIP also grows. Again, you never write a check for this. It simply accrues, becoming part of the total amount that will eventually be paid back when the home is sold. This ongoing premium is what keeps that FHA insurance policy active for the life of the loan. So, we have the origination fee and the initial MIP. What else? Well, just like any mortgage, there are standard third-party closing costs. These are fees paid to other companies, not the lender, for services required to close the loan. This includes things like the appraisal fee, to determine your home's value, a title search and title insurance to make sure you have clear ownership of the property, There are recording fees paid to your county to officially record the new mortgage lien, a credit report fee, a flood certification fee, and maybe some other small miscellaneous costs. These can vary quite a bit depending on where you live, but a good estimate is usually somewhere between $1,500 and $3,000. Let's be conservative and say for Mary, these third-party costs add up to $2,500. So let's do the math for Mary so far. We have the $6,000 origination fee. We have the $8,000 initial mortgage insurance premium. And we have the $2,500 bucket of third-party closing costs. Add all those up and you get $16,500. This is the total amount of upfront costs that will be subtracted from her initial loan proceeds. Now, you might have heard about something called a servicing fee. This was a monthly fee, maybe $30 or $35, that lenders used to charge to manage the loan account over time. The good news is that for virtually all new HECM reverse mortgages issued today, these monthly servicing fees have been eliminated. Lenders now build the cost of servicing into the interest rate, which simplifies things for the borrower. So that's one less thing to worry about. The final and most significant cost over the life of the loan isn't an upfront fee at all. It's the interest. Just like any loan, a reverse mortgage has an interest rate. But the difference is you're not making monthly payments. Instead, the interest accrues every month on your outstanding loan balance and is simply added to the total. This is what causes the loan balance to grow over time. Reverse mortgage interest rates can be either fixed or adjustable. A fixed rate is simple. It's locked in for the life of the loan. You know exactly what the rate will be forever. However, FHA rules require that if you choose a fixed rate, you must take all of your available loan proceeds in one single lump sum at closing. You can't set up a line of credit. An adjustable rate, on the other hand, can change over time, usually once a year. It's tied to a benchmark financial index, like the Constant Maturity Treasury Index or CMT. The benefit of an adjustable rate is that it gives you flexibility. With an adjustable rate, you can choose how you want to receive your money. As a lump sum, as a line of credit you can draw from as needed, as regular monthly payments, or a combination of these. We'll dive deep into those payout options in the next part. The crucial thing to understand about interest is that it only gets charged on the money you've actually used. If you open a $200,000 line of credit but only draw out $20,000, you are only charged interest on that $20,000, not the full $200,000. This is a key feature, especially for the line of credit option. So let's bring it all back to Mary. In the last part, we determined her principal limit. The total amount she was eligible for was about $208,000. Now we subtract her total upfront costs, which we calculated to be $16,500. That leaves her with $191,500. But wait, there's one more step. Mary still has that $50,000 balance on her original mortgage. A reverse mortgage is required to be the primary, or only lien on the property. So, the very first thing that must be done with the loan proceeds is to pay off that old mortgage. That $50,000 is subtracted right off the top. So, we take her $191,500, subtract the $50,000 to pay off her old loan, and that leaves Mary with a net proceed of $141,500. That is the number that matters. That is the actual amount of money available to her, tax-free, to use however she wishes. We started with a $400,000 house, got to a $208,000 loan eligibility, and after all the costs and payoffs we landed on $141,500 of usable cash. Understanding this calculation is everything. It shows you exactly where every single dollar goes. It's not magic, it's just math. Now that we know exactly how much money Mary has to work with, the next big question is, how can she get it? A big check? A monthly deposit? A rainy day fund? The answer is all of the above. And choosing the right option is one of the most important decisions a borrower has to make. This is the moment where a reverse mortgage transforms from a financial concept into a personal, customized tool. It's not a one-size-fits-all product. It's more like a financial toolkit, and you get to choose which tools you want to use. Let's walk through Mary's options one by one, because they're the same options available to any eligible homeowner. First up is the most straightforward option, the lump sum payment. This is exactly what it sounds like. The lender hands over all the available loan proceeds in one single, large payment right after the loan closes. Imagine getting a check for that full $150,000. For some people, this is the perfect solution. If Mary's primary goal was to pay off her remaining $50,000 mortgage, plus a $20,000 high-interest car loan, a lump sum would wipe out those debts in an instant. This immediately frees up hundreds, maybe thousands of dollars in her monthly cash flow. It can be a powerful move to eliminate major debts or to pay for a huge one-time expense, like a major home modification to allow for aging in place. Think walk-in tubs, stair lifts, or a new roof. But there's a massive catch with the lump sum, and it's critical to understand. The moment Mary takes that full $150,000, the interest clock starts ticking on the entire amount. Even if she only spends $70,000 and puts the other $80,000 in a savings account, she's still accruing interest on the full loan balance. This means her loan balance grows faster, and her home equity shrinks faster than with any other option. It's the least flexible and often the most expensive choice in the long run. It's a sledgehammer when sometimes you just need a screwdriver. So, what if Mary wants something more like a steady paycheck? That brings us to our second and third options: term and tenure payments. Let's start with the term plan. With this option, Mary decides she wants a specific amount of money every single month for a fixed period of time. For example, she could say, "I want to receive $1,000 a month for the next 13 years. The lender calculates it all out, and like clockwork, that $1,000 hits her bank account every month. This is great for budgeting. If she knows she has a specific window of time where her expenses will be higher, maybe she wants to help a grandchild with college tuition for the next 4 years, or supplement her income until her spouse's larger pension kicks in at age 75. The term plan provides that predictable, reliable income stream. The downside: when the term is up, the payments stop. If she chose a 13-year term, on month 1 of year 14, the money is gone. This can be a shock if you haven't planned for it. That's where the tenure plan comes in. It's the ultimate solution for longevity risk, the risk of outliving your money. With the tenure option, Mary receives a fixed monthly payment for as long as she lives in her home as her primary residence. Whether she lives there for 10 more years or 40 more years, that check keeps coming every single month without fail. It's a powerful tool for peace of mind. For someone like Mary, whose primary goal is to supplement her Social Security and have a stable financial floor for the rest of her life, this option is incredibly appealing. The trade-off is that the monthly payment amount will be smaller than what she could get with a short-term plan. The lender has to spread that $150,000 over her entire estimated lifespan, so the monthly slice of the pie is naturally going to be thinner. But for many, the guarantee that the money will never run out is worth that trade-off. Now we come to the fourth and by far the most popular and flexible option, the line of credit. Forget the idea of a big check or a monthly payment. Instead, imagine the lender establishes a $150,000 savings account for Mary. It's her money, but she leaves it with the lender. She can draw from it whenever she wants for any reason. If her water heater breaks, she can pull out $2,000. If she wants to take a dream trip to Alaska, she can pull out $10,000. If she goes a whole year without needing anything, she pulls out $0. Here's the magic of the line of credit. Mary only pays interest on the money she actually uses. If she only pulls out $2,000 for that water heater, her loan balance is just $2,000 plus a tiny bit of interest. The other $148,000 is just sitting there waiting, accruing no interest at all. This keeps her loan balance low and preserves her home equity for much, much longer compared to the lump sum. But it gets even better, and this is the single most powerful feature of a reverse mortgage that most people don't know about. The unused portion of her line of credit, it grows. That's right. The amount of money she has available to borrow increases over time, every single month. The growth rate is equal to the interest rate on the loan. So if her loan has a 6% interest rate, her available line of credit is also growing by 6% a year. That $148,000 she didn't touch? A year later, it might have grown to over $156,000. In 10 years, that initial $150,000 could have grown to be an available credit line of over $250,000, completely independent of her home's value. It's a financial safety net that gets bigger and stronger over time, providing an incredible resource for future, unknown expenses. Of course, no single option is perfect for everyone. So, the fifth option is simply a combination. Mary can customize her payout to fit her exact needs. For example, she could tell the lender, "I want to take a $20,000 lump sum right now to pay off my credit card debt. Then, I want a small tenure payment of $300 a month for my entire life to cover my utilities and property taxes. And whatever is left over from my $150,000, Please put that into a growing line of credit for emergencies. This hybrid approach gives her the best of all worlds. She gets immediate debt relief, a lifelong predictable income stream for her basic needs, and a powerful growing safety net for anything else life throws her way. Now there's one final crucial piece to this puzzle that dictates which of these options are even available. It all comes down to the interest rate. Fixed versus adjustable. A fixed-rate reverse mortgage locks in one interest rate for the life of the loan. Sounds great, right? Simple and predictable. But here's the catch, and it's a big one. If you choose a fixed rate, federal regulations require you to take your entire loan proceeds as a lump sum at closing. You cannot get monthly payments or a line of credit with a fixed-rate loan. You are forced into the option that accrues interest the fastest and depletes your equity the fastest. To unlock all the flexible options we just discussed, the term payments, the tenure payments, the line of credit, and all the combinations, you must choose an adjustable rate mortgage, also known as a variable rate mortgage. The word adjustable can make people nervous, and that's understandable. It means the rate can change over time, usually once a year. But it's this very feature that allows for the flexibility of drawing funds over time. It's the key that unlocks the line of credit, and its incredible growth feature. The vast majority of financial advisors and HECM counselors recommend the adjustable rate option precisely because it gives the homeowner control, flexibility, and the ability to keep their loan balance as low as possible for as long as possible. So Mary sits down and looks at her life. She doesn't have a massive debt to pay off. Her main goal is long-term stability and a safety net. For her, taking a massive fixed-rate lump sum makes no sense at all. The adjustable rate line of credit, perhaps combined with a small monthly tenure payment, is almost certainly her best path forward. It's a strategic choice designed not just for today, but for the next 30 years. Choosing how to receive your funds is arguably the most important decision in the entire reverse mortgage process. It dictates how quickly your loan balance grows and how much flexibility you'll have in the future. But now that we understand how Mary can get her money, another question looms large. What are the costs to set all of this up? Are the fees as scary as the rumors say? Let's break down every single dollar and cent involved, because knowing the true cost is the only way to know if it's the right decision. Let's start with the biggest misconception out there: that reverse mortgage costs are some kind of hidden predatory trap. The truth is, they are highly regulated by the federal government, and every single fee must be disclosed to you upfront on official documents. The problem isn't secrecy, it's complexity. There are a few different types of costs, and they all work a little differently. So let's turn on the lights and look at each one piece by piece. Think of the costs in three main buckets. First, you have the upfront costs, which are part of the loan's closing. Second, you have the ongoing costs, which accumulate over the life of the loan. And third, you have the standard third-party fees, the kind you'd see with almost any mortgage. Let's tackle the big one first. The upfront costs. This is where most of the sticker shock happens. The two major players here are the origination fee and the initial mortgage insurance premium, or IMIP for short. The origination fee is what the lender charges for processing, underwriting, and creating your loan. It's their fee for the work they do. Now, this fee is capped by the FHA to protect you. A lender can charge 2% on the first $200,000 of your home's value, and 1% on the value above that. However, the total fee can never, ever exceed $6,000. This is a hard and fast federal rule. So let's use an example. Say your home is appraised at $400,000. A lender could charge 2% on the first $200,000, which is $4,000. Then they could charge 1% on the remaining $200,000, which is another $2,000. Add them together, and you get a maximum origination fee of $6,000. If your home was worth $800,000, the maximum fee is still $6,000. Now, here's a critical piece of information. This fee is often negotiable. The lending market is competitive. Some lenders may offer a much lower origination fee, or even waive it to win your business. It is absolutely one of the key things you should compare when shopping for a lender. Don't be afraid to ask about it directly. Next up is the initial mortgage insurance premium, the IMIP. This one is really important to understand because it's not for you, it's for the FHA. And it's the secret sauce that makes the whole HECM program work. The IMIP is a one-time fee, paid at closing, that is currently a flat 2% of your home's appraised value. So on that same $400,000 home, the IMIP would be $8,000. This might sound like a lot, But this is the insurance policy that funds the single most important protection a reverse mortgage offers: the non-recourse feature. This is the guarantee we talked about earlier. It's the promise that you or your heirs will never, under any circumstances, owe more than the home is worth when the loan is due. If the housing market crashes and your loan balance is $300,000, but your home only sells for $250,000, this FHA insurance fund covers that $50,000 loss. Not you, not your kids. This premium is what you pay for that absolute peace of mind. It turns the loan from a personal debt into a debt secured only by the house itself. So, you have the origination fee and the IMIP. Then you have the third bucket of costs: standard third-party closing costs. If you've ever bought a house or refinanced, these will look very familiar. These are fees paid to other companies, not the lender, for their services in the transaction. This includes things like the appraisal fee to determine your home's value, a title search and title insurance to make sure the ownership is clear, any state or local recording fees, a credit report fee, a flood certification, and other miscellaneous costs. These are not unique to reverse mortgages. They are part of nearly every real estate transaction in the country. Typically, these costs will add up to somewhere between $1,500 and $3,000, depending heavily on where you live. Okay, let's take a breath. We've just added up an origination fee, a hefty insurance premium, and a few thousand in closing costs. On our $400,000 home example, we could be looking at costs around $15,000 to $17,000. And this is the moment where many people say, "No way, I don't have that kind of money sitting around." And they're right. But here is the most crucial detail about all of these upfront costs. You almost never pay for them out of your pocket. Let me repeat that. You do not have to write a check for these fees at closing. In nearly every case, all of these costs, the origination fee, the FHA insurance premium, and all the third-party closing costs are financed. They are rolled into the loan itself. So when your reverse mortgage is first set up, the initial balance isn't zero. The initial balance is the sum of all those costs. The money to pay the appraiser, the title company, and the FHA is taken from your available loan proceeds. This means you can get a reverse mortgage with little to no cash out of your own savings. It's a huge benefit, but it's also a trade-off. Because these costs are added to your loan balance, they will start accruing interest from day one, just like any other money you draw from the loan. It's a classic case of paying now versus paying later. That brings us to the second category of costs, the ongoing costs. These are the costs that are added to your loan balance over time. The biggest one, of course, is interest. Just like any loan, a reverse mortgage has an interest rate. But unlike a traditional mortgage, you're not making monthly payments. Instead, the interest that accrues each month is simply added to your total loan balance. So, if your balance is $100,000, and your interest for the month is $500, next month your balance will be $100,500. This is how the loan balance grows over the years. You'll have a choice between a fixed interest rate and a variable interest rate, and the one you choose often dictates how you can receive your money, something we'll explore in detail later. Alongside the interest, there's one other ongoing fee: the annual mortgage insurance premium. This is the smaller, ongoing cousin of the big upfront IMIP we just discussed. It's calculated annually at a rate of 0.5% of your outstanding loan balance. So, on that $100,000 loan balance, the annual MIP would be $500 for the year. This amount is also added to your loan balance. You don't pay it out of pocket. And just like the upfront premium, this ongoing fee continues to fund that non-recourse FHA guarantee, ensuring your protection remains in place for the entire life of the loan. Finally, there used to be a third ongoing cost called a servicing fee, a small monthly fee, maybe $25 or $35, that lenders charge to manage your account. However, in today's competitive market, most major lenders have completely eliminated this fee. When you're shopping around, you should absolutely confirm that the lender you're considering does not charge a monthly servicing fee. So let's put it all together. The costs are real. On a $400,000 home, the upfront fees rolled into the loan could be around $17,000. Then, over time, your loan balance will grow from the interest that accrues and the small annual mortgage insurance premium that gets added in. This is why a reverse mortgage isn't a get-rich-quick scheme. It's a strategic financial tool where you are trading future home equity for cash flow and security today. The question isn't whether there are costs. There are. The real question is whether the benefit, eliminating your mortgage payment, accessing a tax-free line of credit, being able to afford healthcare and home repairs, and staying in the home you love for the rest of your life is worth those costs. For millions of seniors, the answer has been a resounding yes. Okay, we've dissected the price tag, but what about the payout? How does the bank decide the exact dollar amount you're eligible to receive? Is it based on your age, your home's value, the current interest rates, or some secret formula? We're about to pull back the curtain on the calculation that determines your reverse mortgage payday. It's not just one of them. It's a powerful combination of all three, working together in a precise, federally regulated calculation. Think of it less like a secret formula and more like a three-part symphony that determines the grand total. The official term for what you can borrow is the principal limit, and it's based on three and only three core pillars: the age of the youngest borrower, the value of your home, and the current interest rate environment. Let's break down each one, because understanding these pillars is the key to understanding your potential payout. First up, the pillar that has the most dramatic impact: your age. Or more specifically, the age of the youngest borrower on the loan. If you're applying with a spouse, it's the younger person's age that the entire calculation hinges on. The rule is simple and unwavering. The older you are, the more money you can access. A 62-year-old will be offered a significantly smaller percentage of their home's value than an 82-year-old. Why? It comes down to actuarial science and the lender's risk. A reverse mortgage is essentially a bet on your lifespan. The lender is giving you money today with the understanding that they won't be repaid until you permanently leave the home. For an older borrower, say someone in their 80s, the lender reasonably expects that the loan will likely be repaid in a shorter time frame than for a borrower who just turned 62. A shorter loan term means less time for interest to accrue and less risk for the lender. To compensate for the longer period of risk and accruing interest associated with the younger borrower, the lender offers them a smaller initial principal amount. Let's make this real. Imagine two neighbors, John and Mary. They live in identical houses, both valued at exactly $500,000, and they both have paid off their mortgages. The only difference is that John is 62 and Mary is 82. When they apply for a HECM reverse mortgage on the exact same day with the exact same interest rates, Mary might be able to access around 58% of her home's value, giving her a principal limit of $290,000. John, being 20 years younger, might only be able to access around 45% of his home's value, giving him a principal limit of $225,000. That's a $65,000 difference, based on nothing but age. This is why some financial advisors suggest that if you're on the younger end of eligibility, it can sometimes pay to wait a few years to unlock more of your equity. The second pillar is the value of your home. This one seems obvious. A more valuable home means a bigger potential loan. And that's true, but with one enormous caveat that trips up a lot of people, especially those in high cost of living areas. The value used in the calculation is your home's appraised value, as determined by an independent FHA-approved appraiser. It's not the Zillow estimate, it's not what your neighbor's house sold for, it's a formal appraisal. But here's the critical part. The FHA sets a maximum limit on the home value that can be used in the calculation. This is called the FHA maximum claim amount. For 2024, that limit is $1,149,825. This number is adjusted annually for inflation. What this means is that even if your beautiful California beachfront home is appraised at $3 million, for the purposes of the reverse mortgage calculation, its value is capped at that FHA limit. The lender will only calculate your principal limit based on a home value of $1,149,825. Not a penny more. So, the person with the $1.2 million home and the person with the $3 million home will have the exact same maximum starting point for their calculation, assuming their age and the interest rates are the same. This cap is in place to limit the FHA's insurance risk on very high-value properties. For the vast majority of Americans, their home value will fall under this limit, so their actual appraised value will be used. But if you own a high-value property, this is an absolutely essential detail to understand. Now for the third pillar, and it's the one that's the most counterintuitive: the interest rate. You'd think a high interest rate would be good for the lender, so they'd lend you more, right? With a reverse mortgage, it's the exact opposite. The lower the interest rate, the more money you can borrow. This seems backward at first, but it makes perfect sense when you remember how a reverse mortgage works. The loan balance grows over time as interest is added to the principal you've borrowed. The interest rate dictates how quickly that balance grows. The FHA needs to ensure that your growing loan balance won't exceed the value of your home over your expected lifetime. If interest rates are high, your loan balance will grow very quickly. To protect against that balance ballooning too fast and surpassing the home's value, the FHA allows you to start with a smaller initial loan amount. It's a safety buffer. Conversely, if interest rates are low, your loan balance will grow much more slowly. With less risk of the balance getting out of control, the FHA is comfortable allowing you to start with a larger principal amount. It's all about projecting the future growth of the loan and making sure there's enough equity left in the house to cover the debt when it eventually comes due. So when you hear on the news that interest rates are falling, that's generally good news for someone considering a reverse mortgage, as it could increase their potential payout. So how do these three pillars, age, home value, and interest rates, come together? They are plugged into a formula that generates something called a principal limit factor, or PLF. This is a percentage. The FHA publishes massive tables filled with these PLF percentages. A lender will look up your age, or the youngest borrower's age, and cross-reference it with the current expected interest rate to find your specific PLF percentage. The final calculation is then surprisingly simple. It's your home's value, or the FHA maximum claim amount, whichever is less, multiplied by your principal limit factor. Let's walk through a complete example. Meet Robert. He is 78 years old and a widower. His home in Texas was just appraised at $450,000, which is well below the FHA limit. The current expected interest rate gets him a principal limit factor of, let's say, 0.57 or 57%. So, we take his home value of $450,000 and multiply it by his PLF of 0.57. That gives Robert a gross principal limit of $256,500. This is the total amount of money the reverse mortgage has made available to him. But, and this is a huge but, that is not necessarily the amount of cash he gets to walk away with. This gross principal limit is the starting point from which all other mandatory obligations must be paid. This is a critical step that many people overlook. First and foremost, any existing mortgage on the property must be paid off with the reverse mortgage proceeds. Let's say Robert still owes $80,000 on his original mortgage. That $80,000 comes right off the top of his $256,500 principal limit. Next, you have the closing costs. Just like any mortgage, there are fees. These include the origination fee, the upfront mortgage insurance premium, appraisal fees, title search, and other standard costs. These can total several $1,000s. Let's estimate Robert's total costs are $14,000. That also gets subtracted. So let's do the math. We start with the gross principal limit of $256,500. We subtract the $80,000 to pay off his old mortgage. Then we subtract the $14,000 for costs and fees. That leaves Robert with a net principal limit of $162,500. This is the actual amount of his home's equity that he can now access. This is the money he can use for healthcare, home improvements, travel, or simply to supplement his monthly income. So you have your number, that $162,500 in our example. But it's not just a single check that shows up in your mailbox, unless you want it to be. You have choices, powerful choices. Do you want it all at once in a lump sum? As a steady, reliable monthly payment for the rest of your life, like a private pension? Or as a flexible line of credit, a financial safety net you can tap into whenever you need it, and you only pay interest on what you actually use? Each option has massive implications for your financial future, your taxes, and your eligibility for other government benefits. Choosing the wrong one can be a costly, irreversible mistake. In the next part, we're breaking down every single payout option, revealing the pros and cons the lenders don't always highlight, to help you decide which one is truly right for your retirement. Alright, let's open the financial toolkit. Think of your home equity as a reservoir of funds you've built up over decades. The payout option you choose is the valve you install on that reservoir. Will it be a fire hose, a steady sprinkler, or a simple tap you can turn on and off as needed? The choice you make here will define how this money flows into your life, and more importantly, how the loan balance grows over time. First up is the most straightforward, the one everyone thinks of, the lump sum payment. This is the fire hose. You turn the valve once and your entire available loan proceeds, every single dollar, are deposited into your bank account. This can feel like winning the lottery. Suddenly, you have a massive chunk of cash to work with. This option is often chosen by people who have a large, immediate need. Maybe it's paying off an existing mortgage to eliminate that monthly payment forever. Or perhaps it's funding a major home modification for accessibility, like a walk-in shower and a stair lift, or covering a significant, one-time medical expense not handled by insurance. The upside is obvious: you get all the money right now. There's no uncertainty. The major, and I mean major, downside that lenders might not shout from the rooftops is this: the moment that money hits your account, you start accruing interest on the entire balance. Every single dollar. Even the money that's just sitting in your checking account waiting to be spent. So if you take out $200,000 but only need $50,000 this year, you are paying interest on the full $200,000 from day one. This causes your loan balance to grow much, much faster than with any other option. It's a powerful tool for a specific, large, immediate need. But for anything else, it's like using a sledgehammer to crack a nut. Effective, but with significant collateral damage to your future equity. Next, let's look at the steady stream options. These are your monthly payments, and they come in two primary flavors: term payments and tenure payments. They sound similar, but the difference between them is absolutely critical. Let's start with term payments. With this option, you receive a fixed monthly payment for a specific, predetermined period. You and the lender agree. I want to receive $2,000 a month for the next 10 years. And like clockwork, that money arrives. This can be perfect for someone who has a clear financial gap they need to bridge. For example, maybe you plan to retire at 65, but your larger pension doesn't kick in until you're 75. A 10-year term payment plan could be the perfect bridge, supplementing your Social Security and keeping your lifestyle stable during that decade. The pro is that because the payment period is fixed, the monthly amount you receive is generally higher than the other monthly option. The con: the clock is always ticking. When that 10-year term is up, the payments stop. Period. If you're 75 and still in great health and living in the home, you need to be prepared for that income stream to vanish. This is where the second flavor, tenure payments, comes in. This is the ultimate peace of mind option. With a tenure plan, you receive a fixed monthly payment for as long as you live in your home as your primary residence. It doesn't matter if you live to be 95, 105, or 115. As long as you meet the loan obligations, paying your property taxes and homeowners insurance and maintaining the home, that check will arrive every single month. This is designed to combat what financial planners call longevity risk, the risk of outliving your money. For many seniors, this is their single greatest fear. The tenure payment is a direct answer to that fear. The trade-off, however, is that the monthly payment amount will be lower than what you could get with a term plan. The lender has to spread the risk over your entire potential lifespan, so they calculate a smaller, but more sustainable payment. So you have to ask yourself, do you want more money for a shorter defined period? That's term. Or do you want less money per month, but with the ironclad guarantee that it will never, ever run out? That's tenure. Now we come to what is, for many financial experts, the most powerful and flexible option of all: the line of credit. This is the simple tap on your reservoir. Instead of the lender giving you money, they open up a line of credit that you can draw from as needed. If you need $5,000 for a new roof, you take it. If you need $600 for a car repair, you take it. If you don't need any money for a year, you take nothing. And here's the secret, the part that makes this option so incredibly unique. You only accrue interest on the money you've actually used. If you have a $200,000 line of credit but have only drawn $50,000, you're only paying interest on that $50,000. The other $150,000 is just sitting there, waiting, costing you nothing. But it gets even better. And this is the single most misunderstood and powerful feature of a reverse mortgage. The unused portion of your line of credit grows over time. Let me say that again. The amount of money you have available to you increases every single month, at a rate equal to the interest rate on your loan plus the mortgage insurance premium rate. So if your interest rate is, say, 6%, your available line of credit is growing at a compounding rate of over 6% a year. This growth is guaranteed by the FHA. It has nothing to do with your home's actual market value. Even if the housing market crashes, your line of credit continues to grow. Think about that. It's an emergency fund that refills and expands itself. It's a financial safety net that gets stronger over time, not weaker. For many people, this is the ideal setup. They don't need the money now, but they want the absolute security of knowing it's there and growing for the future, for healthcare costs, for emergencies, for whatever life throws at them. Finally, you don't have to choose just one. Most plans are actually a hybrid. These are called modified term or modified tenure plans. You can combine a lump sum with a monthly payment, or a lump sum with a line of credit. For example, you could take out a $30,000 lump sum to pay off your high-interest credit cards and car loan. and then set up the rest of your funds as a lifetime tenure payment to supplement your monthly income. Or you could take a small lump sum for a trip you've always dreamed of, and leave the rest in a growing line of credit for future needs. The system is designed to be flexible, so you have the fire hose of the lump sum for massive immediate needs. You have the steady sprinklers of term and tenure payments for predictable income, and you have the smart tap of the line of credit for ultimate flexibility and a growing safety net. The key is to look at your own retirement picture, your goals, your health, your existing income, and match the tool to the job. And one more crucial piece of information. For most of these plans, especially the line of credit and monthly payments, you can often change your mind later. If you start with a line of credit and decide 2 years later you'd rather have monthly payments, you can usually make that switch. The big exception is the lump sum. Once you take all the cash, that's it. The valve is open, the reservoir is drained into your account, and there's no going back. Choosing your payout is one of the biggest decisions you'll make. But even with the perfect payout plan, there are dangerous myths and outright scams designed to trip you up at the finish line. We're about to expose the 3 most common reverse mortgage lies that could cost you your home, and the one question you must ask before you sign anything. And the answer might just save you from financial disaster. Let's start with the biggest, most pervasive lie of them all. Lie number 1. The bank takes your home. You hear it everywhere, whispered at family gatherings, stated as fact on internet forums. It's the single greatest fear that stops people from even considering a reverse mortgage, and it is completely fundamentally false. Let me be crystal clear. With a reverse mortgage, you retain the title and ownership of your home. You are not selling it to the bank. The bank does not go on the deed. It is your name and your name alone that stays on the title. What the lender gets is a lien on the property, which is the exact same thing they have with a traditional forward mortgage. That lien is simply a legal claim, a security interest that ensures they get their money back when the loan is eventually due. You can still renovate your kitchen, plant a garden, or paint the walls any color you choose. It is your home. The lie that you're signing away your ownership is a powerful myth, but it's just that, a myth. But that brings us to the second and far more dangerous lie. It's the flip side of the coin, often told by overly enthusiastic loan officers. Lie number 2. You can never lose your home. This is a deadly half-truth. While it's true that you can't be kicked out for failing to make monthly mortgage payments, because there are none, you absolutely can face foreclosure if you fail to meet the core obligations of the loan. Think of them as the 3 golden rules you cannot break. First, you must pay your property taxes. The city and county always get their money first, and if you fall behind, they can and will initiate foreclosure proceedings, which would put your reverse mortgage in default. Second, you must maintain your homeowner's insurance. If your house burns down and there's no insurance to rebuild it, the bank's collateral, their security, is literally gone. They won't allow that risk. Third, you must maintain the property. This doesn't mean your home has to be a palace, but it does mean you can't let it fall into serious disrepair. A collapsing roof or a crumbling foundation jeopardizes the value of the home, and the lender can declare a default. These aren't minor footnotes. They are the bedrock of the agreement. Forgetting them can have the same catastrophic result as defaulting on a traditional mortgage. And that leads us to the most seductive lie of all. Lie number 3. A reverse mortgage is free money. No, absolutely not. It is a loan, and it is one of the most expensive loan products on the market. Let's be brutally honest about the costs we've discussed. You have the upfront costs, the origination fee, which can be thousands of dollars, and the initial mortgage insurance premium, or MIP, which is 2% of your home's appraised value. Then you have the ongoing costs, the annual MIP of 0.5% of the outstanding loan balance, and the servicing fees that are tacked on every single month. And most importantly, you have the interest. Every single dollar you receive, every fee that's financed, starts accumulating interest immediately. It's not interest you pay out of pocket, but it's interest that is added to your loan balance, compounding over time, eating away at your home's equity. This isn't free money, any more than a credit card cash advance is free money. It is a debt instrument. It's a way of turning your home equity into cash, but that conversion comes at a very steep price. Believing it's a free ride is the fastest way to end up with a loan balance that shocks you and your family down the road. So, how do you protect yourself? How do you walk into a lender's office armed and ready? You do it by asking one single question. This question cuts through all the sales talk and forces a clear, direct answer on the most important feature of a HECM loan. Before you sign anything, you must look the loan officer in the eye and ask, "This is a non-recourse loan. Can you please explain in detail what happens if I or my heirs owe more on this loan than the house is worth when it's sold?" Why is this question so powerful? Because it forces them to confirm on the record the single greatest protection built into an FHA-insured reverse mortgage. The term non-recourse is the magic word. It means the lender can only ever be repaid from the proceeds of the home's sale. They cannot come after your income, your other assets, your savings, or most importantly, your children's assets to cover any shortfall. If you live to be 105 and your loan balance balloons to $500,000, but your home is only worth $400,000 when it's sold, that $100,000 difference is not your problem. It's not your family's problem. It is covered by that FHA mortgage insurance you've been paying for. The lender and the FHA absorb the loss. Asking this question proves you've done your homework. It signals that you are an educated consumer, and it ensures there is absolutely no ambiguity about this critical safeguard. The answer should be simple and direct. Your estate will never owe more than the home's value. If you get any hesitation, any confusing jargon, or any answer other than that, you walk away. Now, with those lies debunked and that critical question in your arsenal, let's tackle the final practical what-ifs that keep people up at night. What if you take out a reverse mortgage and a few years later, you decide you want to sell your home and move to a condo by the beach? You can. It's your home. You sell it just like any other house. At closing, the proceeds from the sale are used to pay off the reverse mortgage balance, the principal, the interest, and the fees. Whatever is left over is your money tax-free, to do with as you please. What if your health changes and you have to move into a nursing home or assisted living? The reverse mortgage rules anticipate this. You can be out of your home for up to 12 consecutive months for health reasons without the loan becoming due. This gives you time to recover or to make permanent arrangements. However, if after that 12-month period it's clear you won't be returning, the home will no longer be your primary residence, and the loan will become due and payable. And this brings us to the final, most emotional question. What happens when I pass away? This is where the most confusion and fear lies for your children and heirs. But the process is actually very straightforward. After you pass, your heirs will be notified by the loan servicer and are typically given 6 months to decide what to do, with the possibility of extensions. They have 3 basic options. Option 1. Keep the home. If they want to keep the family home, they can pay off the reverse mortgage balance. They can do this with their own money or by getting a new traditional mortgage in their name. They only have to pay off the lesser of the loan balance or 95% of the home's current appraised value. Option 2. Sell the home. This is the most common choice. They sell the house on the open market. At closing, the reverse mortgage is paid off, and any remaining equity, whether it's $100,000 or $10,000, goes directly to them, to your estate. Option 3. Walk away. If the loan balance is higher than the home's market value, if the house is underwater, they can simply give the keys to the lender. Thanks to that non-recourse feature, they owe nothing. The FHA insurance covers the loss. They are not responsible for the debt. There is no bill sent to your children. So, after all of this, what is the final verdict? Is a reverse mortgage a godsend or a trap? The truth is, it's neither. A reverse mortgage is a tool. A powerful, expensive, and complex tool. Like a chainsaw, in the right hands it can be incredibly useful for clearing away financial burdens and building a more stable future. But in the wrong hands or used without understanding, it can cause devastating damage. It might be the right tool if you are house-rich but cash-poor, if you are determined to age in place in your forever home, if you have no heirs or your heirs are financially stable and understand and support your decision, and if you can comfortably afford the ongoing taxes, insurance, and upkeep. It is almost certainly the wrong tool if your main goal is to leave a debt-free home to your children, if you might want to move in a few years, if you struggle to pay your property taxes right now, or if you don't have a clear plan for how the money will improve your quality of life for the long term. Your journey shouldn't end with this video. Your very next step, if you are still considering this path, should be to schedule a session with a HUD-approved reverse mortgage counselor. They are an independent, unbiased resource required by law to educate you. Talk to a trusted financial advisor. Talk to your family. Your home is more than just an asset. It's your sanctuary, your history, the center of your world. A reverse mortgage can either reinforce the walls of that sanctuary, giving you the freedom and security to live out your years in peace, or it can slowly, silently dismantle it from the inside out. Now you have the knowledge. You know the mechanics, you know the costs, and you know the hidden dangers. The choice is yours. Choose wisely.